There's a pattern that has only appeared twice in the last 50 years of silver trading. A specific alignment of technical, fundamental, and institutional forces that, when they converge, has historically preceded some of the most violent upside price moves the silver market has ever seen. Traders who study this pattern call it the 1980 breakout formula. And right now, for just the second time in modern history, every single condition inside that formula has been triggered simultaneously. I want to be very clear about what this means. This is not a prediction. This is not speculation. This is a historical pattern recognition exercise backed by hard data. And the data is telling a story that anyone holding savings in traditional assets needs to hear immediately. Let me take you back to where this formula was born, because the story behind it is one of the most dramatic chapters in financial history. And understanding what happened then is the only way to fully grasp the magnitude of what is unfolding right now. It was 1979. America was bleeding. Inflation had spiraled into the double digits. The dollar had been unmoored from gold for nearly a decade, since Nixon's famous closing of the gold window in 1971, and the consequences were now playing out in full force. The stock market was going nowhere. Interest rates were being hiked to levels that would crush most modern balance sheets. Ordinary Americans who had done everything right, saved diligently, worked hard, planned for retirement, were watching the purchasing power of their nest eggs dissolve month after month like a sandcastle at high tide. Against this backdrop, a pair of brothers from Texas named Nelson Bunker Hunt and William Herbert Hunt quietly began doing something that had never been attempted before in the modern era. They started accumulating silver. Not a little bit of silver, not a modest position. These were Texas oil billionaires, and they thought big. Working with international partners, including members of the Saudi royal family, the Hunt brothers methodically pulled physical silver off the market. They weren't trading paper. They weren't rolling futures contracts. They were taking delivery of actual metal and removing it from the system. By the time the financial world realized what was happening, the Hunt brothers and their associates had cornered roughly 200 million ounces of silver. That was approximately 1/3 of the world's entire above-ground silver supply at the time. What happened next was historic. Silver exploded from around $6 an ounce at the start of 1979 to nearly $50 by early 1980, an eightfold move in roughly 12 months. Families who had bought silver coins and held them in sock drawers suddenly found themselves sitting on fortunes. People who had dismissed precious metals as a relic found themselves staring at numbers that defied everything they thought they knew. Then the exchanges changed the rules. The COMEX introduced emergency position limits, effectively making it impossible for the Hunts to continue accumulating. Margin calls cascaded. The brothers couldn't cover. Silver crashed almost as violently as it had risen. The episode became known as Silver Thursday, one of the most dramatic market events of the 20th century. Now, here's what most people have never been taught. After the Hunt brothers episode, after the smoke cleared, analysts went back and studied the conditions that existed in the months before silver exploded. They looked at the technical chart structure. They examined the supply-demand dynamics. They analyzed the COMEX warehouse data, the paper to physical leverage ratios, the institutional positioning, and they found something remarkable. Before silver moved from $6 to $50, a very specific set of conditions had all aligned at the same time. Researchers began calling this the breakout formula. Not because anyone planned it, but because in hindsight, it was perfectly identifiable as the pre-ignition sequence for one of the greatest commodity surges in history. And right now, that formula is flashing again. Let me walk you through each component of it, one by one, because when you see all of these pieces together, you will understand why serious analysts are calling this a once-in-a-generation moment for silver. The first component of the 1980 formula was what analysts call structural physical tightness. In the late 1970s, before the explosion, the amount of silver actually available for delivery on futures contracts began declining relative to the amount of paper silver outstanding. In other words, more and more contracts were being written against less and less real metal. This creates a dangerous tension in the market, a kind of financial spring being slowly compressed. When something triggers a rush to deliver or to take physical possession, that spring releases all at once. Right now, COMEX registered silver inventories, meaning the metal actually available for delivery against futures, are under enormous stress. Over the last 18 months, roughly 117 million ounces have been pulled from COMEX-approved vaults, representing more than a 20% decline. Meanwhile, the open interest in silver futures contracts has remained extraordinarily high. When you divide the total paper claims outstanding by the registered metal available to cover them, you get a leverage ratio that is historically alarming. For every ounce of registered silver sitting in COMEX vaults, there are multiple paper claims that could theoretically demand delivery. This is not a normal market. This is a market under structural physical stress, the same kind of stress that existed in late 1979. The second component of the 1980 formula was a multi-year supply deficit. In the years leading up to the Hunt brothers squeeze, silver was already in a supply shortfall. Demand was beginning to creep ahead of production. This deficit was modest at first, easily masked by above-ground stockpiles being drawn down. But those stockpiles were finite. Eventually, the math catches up. What we are dealing with today makes the pre-1980 deficit look trivial by comparison. The silver market has now posted 6 consecutive years of structural supply deficits. The Silver Institute has documented that more than 762 million troy ounces have been withdrawn from global stockpiles since 2021 alone to cover the gap between production and consumption. Let that number sink in. 762 million ounces of silver that used to exist as cushion, as buffer, as supply waiting to be deployed, gone, consumed, delivered into the industrial economy and into investor hands. The global silver supply cushion that historically absorbed demand shocks is not just thin right now. For all practical purposes, it has been eliminated. The projected supply shortfall for this year alone is approaching 50 million ounces, and the trend shows no sign of reversing. Before I keep going, look, if any of this is making you think about your own financial security right now, I put together a free guide that shows the specific strategies thousands of American retirees are quietly using to protect their hard-earned wealth from exactly the kind of monetary environment we're living in. You'll find it linked in the description below. Take a look when you get a chance. Completely free, no strings attached. Now, back to what's happening in silver. The third component of the 1980 breakout formula was a demand catalyst with an inelastic quality, meaning buyers who simply could not stop buying, regardless of price. In 1979, that inelastic demand came from the Hunts and their partners. When price went up, they didn't sell, they bought more. This is what created the squeeze dynamic that overwhelmed the market. What exists today is something far more powerful and far more permanent than two families with deep pockets. The inelastic demand today is structural, industrial, and driven by forces that no government regulation can simply switch off. Silver has become the essential raw material for the technologies that define the 21st century. Solar panels cannot be manufactured without silver. Every single photovoltaic cell requires it. The electrical conductivity of silver is simply unmatched, and there is no cost-effective substitute. Solar photovoltaic demand for silver has increased roughly 12-fold over the last decade alone, and the global build-out of solar capacity is still in its early innings. Electric vehicles require somewhere between 67 and 79% more silver than traditional combustion vehicles. Each EV on the road is a silver demand machine that will run for 15 to 20 years, requiring silver in its charging systems, its electrical architecture, its battery management circuitry. The global EV fleet is growing by tens of millions of vehicles per year. Then you add artificial intelligence. The data centers being rushed to construction around the world to power AI workloads require massive quantities of silver, their power management systems, their cooling infrastructure. The Silver Institute has documented that data center and AI-related silver demand is now one of the fastest growing categories in the entire market. All of this industrial demand, solar, EV, AI, now accounts for more than 56% of total global silver consumption. And here's the crucial point. None of these industries can simply choose to stop buying silver when the price gets uncomfortable. Boeing cannot decide to use a different conductive material in aircraft electronics because silver got expensive. A solar manufacturer cannot reformulate its panels without silver. The demand is locked in. It compounds with each passing year. It is structurally inelastic in a way that no speculative position ever could be. The fourth component of the 1980 formula was monetary instability. The late 1970s were defined by an inflation crisis that destroyed confidence in paper assets and drove capital toward tangible stores of value. People weren't buying silver just because they thought it was cheap. They were buying silver because they didn't trust what was happening to the value of their money. I don't need to spend a lot of time on this for you, because if you're watching this video, you already understand the world we're living in. The national debt trajectory is one that most serious economists describe in the same hushed, concerned tones people used when discussing the debt crisis of the 1970s. The dollar has lost an extraordinary percentage of its purchasing power over the last several years. Geopolitical realignment is underway on a scale not seen since the post World War II order was established. Countries that once automatically held their reserves in dollars are actively diversifying. The BRICS nations have made reducing dollar dependence an explicit foreign policy objective. Central banks around the world, the very institutions that hold the gold standard of monetary credibility, have been accumulating precious metals at rates not seen in generations. These are not paranoid retail investors making emotional decisions. These are sovereign entities with research departments, intelligence services, and economic modeling that most investors never see, and they are buying continuously, relentlessly. The fifth component, and this is the one that market technicians have been watching most carefully, is the chart structure itself. The 1980 breakout formula includes a very specific technical pattern, a prolonged consolidation below a key resistance level, followed by a decisive break through that level with expanding volume and momentum. It is the visual fingerprint of a market that has absorbed every ounce of available supply, compressed every seller who can be found, and then simply run out of sellers entirely. When that final seller capitulates, the price doesn't drift higher. It gaps. It surges. It moves in ways that shock anyone who is only watching the price and not the underlying structure. Those watching the silver market's technical structure have noted that silver recently cleared the nominal all-time high set during the Hunt Brothers squeeze, a level that had capped the market for over 4 decades. That kind of breakout above a 45-year resistance ceiling is not a routine event. In technical analysis, the longer a resistance level holds, the more powerful the breakout becomes when it finally clears. 45 years of supply sitting above that price, 45 years of anyone who bought silver at or near the 1980 peak waiting to finally get out even, and now that supply has been absorbed. There is no longer a ceiling. Here's what makes today fundamentally different from 1980, and why analysts who understand both periods believe the current setup is actually more explosive in its potential, not less. The 1980 move was driven by 3 Texas brothers and a group of Saudi investors. When the exchange changed the rules and margin calls hit, the move reversed violently. The entire episode was about artificial demand created by a handful of actors using leverage. Remove the leverage, the price collapses. Today, the demand driving silver is not artificial. It cannot be margin called away. You cannot make a phone call to the solar industry and tell them to stop needing silver. You cannot issue a regulation that reduces the silver content required in electric vehicles. The demand is embedded in the infrastructure of the global energy transition. It grows each year as more panels go up, more EVs hit the road, more data centers come online. And simultaneously, roughly 70% of silver supply comes not from dedicated silver mines, but as a byproduct of mining for other metals, copper, lead, zinc. You cannot simply dial up silver production in response to higher prices, the way you can with other commodities. Building a new mine takes 7 to 10 years minimum. The supply response is structurally constrained in a way it simply wasn't in 1979. Now, I want to talk specifically to those of you who are watching this with a significant amount of retirement savings. Because everything I've described, the supply deficit, the monetary instability, the geopolitical realignment, the COMEX stress, the breakout pattern, this is precisely the environment in which retirement savers face the most serious threats to their wealth. Not because anyone is doing anything wrong, but because the financial system itself is under strains that show up in the purchasing power of your saved dollars, in the volatility of the stock market, in the hidden erosion that happens when the denominator of your wealth, the currency it's measured in, is itself under pressure. If you have retirement savings of $100,000 or more, there is a way to get physical precious metals working inside your existing retirement accounts without triggering the taxes and penalties that most people assume would apply. It's called a gold IRA, and it's a structure that allows you to hold physical gold and silver within an IRA just as you would hold stocks or bonds. I covered the basics in a free guide I put together. It's linked in the description below. Worth at least reading through to understand the mechanics, because the window to make strategic moves like this tends to narrow exactly when markets are moving in the ways we're discussing today. Most people find out about these options after the move has already happened. That is not a position you want to be in. Let me bring this full circle back to the formula itself, because I want to make sure you leave this video with a complete understanding of what has actually been triggered. The 1980 breakout formula is not a single indicator. It's a convergence, a multi-factor alignment where the structural, technical, fundamental, and monetary pieces all click into place simultaneously. In 1980, that convergence produced a roughly eightfold price move over approximately 12 months before the artificial demand was deliberately disrupted. Today's convergence lacks the artificial component, but it has something 1980 never had: global industrial demand that cannot be turned off, a supply deficit in its sixth consecutive year, and a geopolitical backdrop in which nations themselves are racing to accumulate physical precious metals as insurance against a monetary system they no longer fully trust. The gold-silver ratio tells part of this story in a particularly clear way. Historically, when silver has been trading at its most undervalued relative to gold, when the ratio is elevated and the spread is wide, it has consistently preceded periods of dramatic silver outperformance. The ratio has already begun compressing, meaning silver is starting to close the gap with gold. Historically, these periods of ratio compression tend to be violent and fast. When silver moves, it tends to move faster and further than gold on a percentage basis, because it's a smaller market, because it has that dual demand engine of industrial plus monetary, and because when the mainstream investment public belatedly discovered silver after years of ignoring it, the flow of new capital is disproportionate to the size of the market. Think about what it means when something the size of the silver market, a market a fraction of the size of the gold market, of the bond market, of the stock market, suddenly attracts a meaningful reallocation of wealth from investors fleeing dollar-denominated assets. There is simply not enough supply at current prices to absorb that demand without dramatic price adjustment. The math is unavoidable. This is what the 1980 breakout formula ultimately represents: not just a chart pattern, not just a historical curiosity. It is the fingerprint of a market where every equilibrium mechanism has been exhausted, where the supply cannot be expanded quickly, where the demand cannot be turned off, where the monetary backdrop makes paper alternatives less and less attractive, where the technical picture has resolved in a way that removes the final obstacle to a sustained structural price advance. Every single element of that formula is present in the silver market right now. Not most of them, not some of them, all of them. That does not mean silver will go up in a straight line. Nothing in markets moves in a straight line. There will be volatility. There will be corrections that shake weak hands out of positions. There will be moments when headlines say the rally is over and the fearmongers get their screen time. That is the nature of markets, and it was true in 1979 and 1980 just as it is true today. The Hunt brothers themselves watched silver dip multiple times during its ascent before it ultimately made its historic move. What I would leave you with is this: the people who watched the 1980 episode unfold and waited too long to act, waited until the mainstream news was covering silver's historic prices, waited until their brother-in-law called them excitedly about silver. Those people either paid dramatically higher prices or missed the move entirely. The pattern is in its early stages. The institutional accumulation is happening quietly. The industrial deficit is being absorbed silently inside supply chains that most retail investors never track. The COMEX stress is visible only to those who bother to look at the warehouse data. The breakout above 45 years of resistance happened, but the mainstream financial press barely covered it. You are here, watching this video, which means you are paying attention while most people are not. That information advantage is only valuable if it translates into action before the window closes. If you stuck with me through this entire video, I want to make sure you're set up with more than just awareness. I have a free guide linked in the description that walks through the specific saving strategies thousands of American retirees are using to protect and position their wealth right now. And if you have $100,000 or more in any retirement account, IRA, 401k, 403b, any qualifying account, and you mention that you watch this video when you reach out through the guide, my team will set you up with a complimentary one-on-one educational session. No obligation, no sales pressure. Just a private web conference where we walk through exactly how these strategies work and whether they make sense for your specific situation. That offer is exclusively for those who watched all the way to the end, because those are the people who are actually serious about protecting what they've built. The link is right below this video. The formula has been triggered. The question now is simply what you do with that information.